A common property investment rule of thumb is that you should buy property and never sell. And I guess that's because property values over the long term trend higher, which means you would benefit from the compounding capital growth. Of course, that rule of thumb should be adjusted to include you should only buy quality property and then you should never sell it. And that would ensure you maximise your investment returns. But the reality is that sometimes the smartest thing to do is to sell a property, even if it's a quality asset, especially if it helps you move forward achieving your goals. So in today's show, I have a chat with independent financial advisor Stuart Weymss, and we discuss how to decide if your investment property is a dud and if you should sell it, or even if your property is performing well, what are the common scenarios where we would recommend you sell your property? So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
A lot of people think my investment philosophy is to buy and never sell property, but that's not actually true. My philosophy is to buy and seldom sell. Sure, you make your best returns by buying quality assets and holding them for the long term, but sometimes circumstances dictate it's better to sell than to hold onto a property. So how do you know when it's the right time to sell? How bad does an investment have to be before it's time to sell up? That's what I'm going to ask my regular guest and independent financial advisor, Stuart Weymss. Regular listeners would know Stuart's more than just an accountant. His firm, Pro Solution Private Client, gives independent accounting, mortgage and financial advice to its clients. So, hi, Stuart.
Hey, Michael. Great to be back with you.
Now, I find it interesting that many investors recently seem to have sold up their investment properties over the last year or two during the property boom, and I think they were enticed by strong capital growth that they achieved. Now, to me, it's counterintuitive because they're selling their best properties, the ones that are performing well. In fact, their properties are doing exactly what they hoped they'd do. On the other hand, I've seen some emotionally involved investors hold on to dud properties in the vain hope that their performance will improve. So let's start with a simple question. How bad does an investment property need to be to warrant selling it?
Well, of course, if we go and sell a property, it's not neither a riskless nor a costless exercise. When I say riskless exercise, I mean the last thing you really want to do is sell a property for $500,000 and then 7 years later read in the paper it's resold for $1 million, because you'd only kick yourself doing that. And the amount of times I've heard, and I'm sure you've heard the same sort of stories, Michael, the amount of times you hear a client reflect back on, I owned a property in this street and we sold it for X and it would be worth Y now. And they kick themselves, they should never have sold that asset. I mean, if I had $1 for every story like that, I'd have a lot of dollars.
You do have a lot of dollars, Stuart, because you actually hold on to your properties.
Well, that's true too, but it is a common observation from people. So that's the risk, is the opportunity cost of making the wrong decision and not having enough patience to ride it out, because you're not always going to get stellar returns every single year. And we know in the property market, there's periods of very flat growth, sort of sideways movements. And then there's periods like we've just enjoyed over the last couple of years of very strong growth, but they're not going to happen all the time.
And that's what surprised me, what I said a moment ago, Stuart, that because of the strong growth, it's anecdotal evidence, but it's actually well known in the industry that a lot of investors just sold up last year because an estate agent tapped them on the shoulder and said, hey, I've got a buyer for your property. And he did, and they could get a great price. Maybe it's because they really didn't have a plan to start with. They didn't even know what their strategy was.
Well, that's very true. And if your property is a really good asset and there's no reason to sell, and I'm sure we'll talk about, what are some of those reasons during the podcast. But if there's no reason to sell, then why would you sell? Because you've got to think about, what else am I going to do with the money? And if you have to reinvest it, why not just leave it invested in an otherwise okay asset? But coming back to how bad does it have to be? That we talked about the sort of risk. If you make a wrong decision, will you kick yourself later on? And then the costs, selling costs, and selling costs are one thing. But if you held the asset for a while and you've enjoyed some good capital growth, then capital gains tax is going to be a big, I guess, financial and emotional hurdle to some degree to get your head around. Do you really want to pay that amount out to the government? Because at the end of the day, of course, it's an unrealized liability. We can't make it disappear unless the property's value, plummets. We're going to have to pay capital gains tax at some stage. So it's not avoidable, but the longer you delay paying it, the better off you are, because you get to reinvest or benefit from the pre-tax compounding capital growth.
Yeah.
If a property has only marginally underperformed, then it's unlikely that the risk and costs associated with selling that asset and replacing it are going to warrant doing so. So my analysis is it has to underperform by around about 2% per annum in terms of capital growth,
compared to something that you could get in its place.
Yeah, and look, I think most people are. Well, if they go and get some advice, this would be true. But I think most people really reflect and say, look, I bought this asset. It's not a great asset. It's on a busy main road. I should have bought something around the corner, something slightly different. I realize that mistake now, and no one purposely, goes in knowing that they're making a mistake. Otherwise, they wouldn't do it, right? So they reflect after the fact. So then I think what you need to do is consider what would have the growth rate been if you had have not made that mistake, compared to what is your current growth rate. And then most importantly, what do I expect in the future? And I would probably imagine you'd expect history to repeat itself. And if there's a disparity in growth rates, that it would continue.
Well, I think that's important to annually review your property portfolio's performance, and really with somebody independent, somebody outside, because most of us are too emotionally involved, too closely attached, invested too much time and emotion. So I think that's a good question. What did I expect it to perform? How has it performed? And if it hasn't performed, why hasn't it? I mean, is it a short-term thing? Is it just a market cycle? Is it something that you can fix, maybe by renovating, bringing it up to standard to be more attractive to potential tenants and manufacture some capital growth? Is it I need a different property manager? Or is it really just a dud? And unfortunately, there are some properties that outperform and some that underperform. That's just the way averages work out, Stuart.
Yeah, and I like to ask, Michael, is it an asset-specific issue or is it a market-wide issue? Because I know we've done a episode once on investment-grade apartments, for example, and really, as a sector, particularly in Melbourne, they've underperformed. Now, why? Well, we spoke about some of the reasons why that might happen, but that's not because, so you might own an investment-grade apartment. It might be a fantastic asset. It just hasn't performed yet, but there's nothing wrong with that specific asset. In that situation, you need to have the patience and discipline to hang in there. But if you have a house, for example, because houses have performed compared to our apartments much better, and if you have a house and all the other houses around it have performed much better than yours because of whatever impairment it might have, well, you've got to be realistic about, past mistakes and not stick your head in the ground or pretend that it might turn around or cross your fingers and hope that it will turn around. Or even one thing, Michael, that some people say is, look, I'll sell it when I'm at break-even point.
Yeah. Oh, yes.
That doesn't make sense either. If there's no wrong time to buy a really good quality asset, which I believe, then there's no wrong time to sell a really poor quality asset. Of course, you want to do it strategically, but just if you've made a mistake and you feel like you're digging a hole, stop digging and sell the asset.
The other thing people tell us is, it's washing its face. It's not costing me anything. What they don't recognise is the opportunity cost, Stuart.
Borrowing capacity is a scarce resource, not investment-grade property. There's plenty of investment-grade property for you and me to go out and purchase and select and purchase. It's our borrowing capacity and our ability to service those borrowings that's the scarce asset. And you want to allocate the scarce asset with the greatest amount of return. So you're right. You bang on, Michael. I've heard that too. Look, it's washing its own face. It's the income more than pays for all the expenses. So why do I need to bother? Well, my argument is because exactly right, the opportunity cost. If you take that equity and borrowing capacity and allocate it to a different asset, in the long run, you'll be miles ahead.
Now, the best way to do this is not with gut feel, not with gut reaction, but actually to run numbers and figures. And I know that's what your team does at Pro Solution Private Clients, and so do our property strategists. And interestingly, the friend of one of our daughters asked me a question about whether she should sell an underperforming property, an apartment in East St Kilda. I know she'll be listening to this because she loves the podcast. And my gut feel was, yeah, it actually would be better to sell and buy a property equivalent price in Brisbane. But when our property strategist actually ran the numbers and figures, it took so many years to actually catch up, and therefore so many assumptions could be wrong between now and then, that if it's going to take 10 years to actually catch up and then get ahead, it probably doesn't make sense. So you've got to take into account numbers, figures, and make some realistic assumptions.
Yeah, it's important to have all the data, but it doesn't surprise me. In fact, I mean, you've got to, for it to be worthwhile selling, it's got to be a real dud. And I find in my experience that you get sort of three categories of properties, if you like. Ones that are no-brainers in terms of they're great assets. They've performed well, and you can see why they've performed well. Ones that have done virtually nothing in terms of returns. And I'm talking about capital growth here, not necessarily income returns. And then there might be a few in the middle, but they're sort of, you look at them and go, oh, it's okay, hasn't shot the lights out, but it's not terrible. I think when you look at these sorts of assets, in most cases, it's relatively clear which ones need to be sold. And if there's any uncertainty, I would probably hang on to the asset rather than sell it. But really continue to review it and continue to really watch it closely, because you can't unsell something, of course. So if you're going to sell it, you want to, I think, have a high level of confidence that it is the right thing to do.
So when you're doing the numbers and figures for your clients, what costs of buying and selling do you take into account before making a decision?
Well, you've got to work out why you're selling in the first place. Is it really just because of underperformance, or is there some other benefit that's going to give rise to selling, such as cashing out and reducing non-deductible debt, or, helping you take that equity and put it into a better quality asset, etc. But if we're just looking at, selling because it's an underperforming asset, then what I want to take into account is all the selling costs, so agent fees, if I need to spend some money on it to get it ready to sell, etc., capital gains tax. And then I've got all the expenses associated with replacing that asset. So buyer's agents cost in order to select the correct asset, stamp duty and other costs going in. So they're the main costs, Michael, that
There's a
I'd need
couple of
to...
little ones people tend to forget as well, because often then you have the property vacant for a while it's on the market. Then there's 60 days, 90 days maybe for settlement, and there are often some other associated conveyancing costs. None of them are big, but when you add them all up, you've got to throw all those into the mix as well, don't you?
Yeah, that's right. I mean, it's important to do numbers properly, of course. The biggest unknown cost is what will this property grow at in terms of what will its capital growth rate be, and what will the capital growth rate of the replacement asset be. And I think we've got to make friends with the fact that a lot of that has a high level of uncertainty, both those figures, because what we're trying to do is forecast what the future might hold. If I go and buy an asset, for example, if I'm going to replace an asset, I obviously don't want to make another mistake, because I worked out that making a mistake is very costly. It wastes time, it wastes money, and it takes. I wrote a blog a few years ago, and I said that it's along the theme. It takes probably 5 years to work out that you've made a mistake, a property mistake, that is, because after a couple of years, and if it hasn't grown, you can't just turn around and say I'll sell it because 2 years I haven't got great returns. It's not always possible in the property market. So if you're going to replace an asset, I would say that the best thing that you can do to reduce your risk is make sure you go and get good advice when replacing that asset. Now, it might be tempting to skimp on fees because you think, well, I've already got to pay capital gains tax, I've got to pay a selling agent, et cetera, et cetera. I've got to pay stamp duty again. So I'll try and minimize the costs associated with replacing the asset. But what you're doing then is giving rise to more risk and inviting yourself to make another mistake again.
It's impertinent to think that you're going to make a better decision this time round. So I agree with you. It's best to invest in your future, pay advisors, because invest in your future because you're going to spend the rest of your life there anyway. So you may as well take the time and money to do it right.
Yep, spot on.
What are some of the circumstances where you have suggested to your clients that you recommended that it would be a good idea to sell? Firstly, underperformance, poor investment returns. What else?
Liquidity. One of the good things about property is that we invest and enjoy compounding capital growth, which is fantastic. And we all know the laws of compounding capital growth, that they really start to kick in substantially after 10 years plus of ownership. And, if you held a property for 30 years, you're really enjoying, in dollar terms, substantial returns on average each year as the property grows. The only problem, though, of course, is that you can't pay living expenses from that capital growth. It's an illiquid asset. And if you're enjoying a very high level of capital growth, chances are that you've got a lot of land value as well. And so unless you've developed the property, it's not necessarily going to be delivering a lot of income either. And so sometimes it's necessary then to adjust an asset allocation through selling of an asset so that we can invest those monies in more liquid assets. And I would say that would be true maybe approaching retirement. I'd really underline maybe, because often we'd probably want to sell the asset post-retirement when taxable incomes are lower. So you don't want to do it too early, of course, because you really want to benefit from that compounding capital growth. But as we get into retirement, it can start to make a bit of sense. And one of the benefits of investing in an asset that's more liquid is that you can sell down progressively. So you can still invest the money mainly for capital growth if that's what you want to do. But if you've got more of a liquid asset like shares, for example, you can sell down progressively to help fund living expenses in retirement. Unfortunately, you can't do that with a property. You can't progressively sell.
One of the things I like about the advice you give your clients is it's a holistic approach. It's not property only. And even though you're a financial planning firm, it's not shares or managed funds. And I think to grow true wealth, you actually need a combination of both of those. So the shares are giving you a level of liquidity, also cash flow, or the shares or the managed funds, and the property is giving you a level of capital growth. So that makes a lot of sense to it.
I think maybe also, Michael, that if you're in that position, it's a symptom of poor planning, right? So I think you said at the beginning your strategy is buy property, seldom sell. And I would totally agree with that, because if you've got a really good quality asset that's performing well, why would you ever want to sell that asset? Just only when you absolutely have to sell it, but you wouldn't sell it otherwise. So if you get to a point, and it's not really a criticism, because, I guess we all make mistakes in our investing lifetime. But if you get to a situation where you are lacking liquidity, where you're sitting on a really good net worth, but somehow can't work out you're going to retire, that's more a symptom of poor planning previously rather than a property strategy not working. So when I develop a strategy, I will almost always do it without needing to sell a property asset. So these things can be avoided or navigated through, I think, if you get good quality advice up front, if you've got a good long-term strategy, rather than getting surprised. But by the same token, the whole point of investing in property in the first place is to help you fund retirement. So if you get to a point where you go, well, I want to retire now, now I have to sell an asset, don't kick yourself for it, because if you've made a good investment 20 years ago and you're sitting a whole bunch of equity, that's the whole reason you did it in the first place. So it is what it is, and at least you get to move forward and you get to have a comfortable retirement.
I think I see two things out of what you just said. First of all, buying property is not a plan. Buying a property, investing in property is not a strategy. A strategy involves a asset accumulation stage, and then you've got to work through the next stage where you're lowering your loan to value ratios and then eventually living off your property portfolio or your asset base, really, not just your property portfolio. But I think the other thing is independent advice is important, because a lot of people out there are paid to sell you property or to buy you property. And so if you ask them in your 5 years from retirement, should I buy a property? They'll say yes. While I know your firm has a more holistic approach, and at Metropole, similarly, we don't encourage people to take on a lot of debt close to retirement, because they're going to have to sell it up at some stage. It's just not going to work unless they've got exceptional circumstances, unless they're expecting to sell their business and have a big payout.
What does Warren Buffett say? Never ask your barber if you need a haircut. Yeah, I mean, spot on. And I think you made a good point previously, Michael, about getting independent advice when looking at particular property asset, and particularly someone that's independent from the original choice to buy that asset. I think that's important. If you used a particular buyer's agent and you went back to that buyer's agent and said, "What do you think? Do you think it's still a good asset?" I mean, I'm not saying they're always going to say, yeah, I still think it's a good asset, but you're asking them to admit a potential mistake. And I'm not saying there's a mistake there either, by the way. But
not necessarily, but also that they genuinely probably believed it was good. Their belief system won't have changed, but they probably don't know the other areas, the other opportunities, the other options that are around.
Yeah.
So you've given us a couple of reasons why. So I think another one could be because you wanting to upgrade your home. This asset you bought has served its purpose and now it's time to move on.
Yeah, I think when you ask yourself the question, put that differently, you need to ask yourself the question, why would you sell? What's the benefit of selling this asset? And you'd ask this question if it was an otherwise good asset, right? So if it's a poor asset, it's a poor quality asset, there's some sort of impairment with it, well, it's very easy to understand why you'd want to sell that asset. But in the case of you've got yourself a really good property, and to refer back to, your commentary at the beginning, Michael, people selling over the last couple of years because they could get a good price. The thing you've got to ask yourself is why sell? Is it really going to help your strategy, your investment strategy? Is it really going to change your life? Is it going to help you move forward? And that's the key question. Now, sometimes, for example, we might have a client that's invested in a couple of properties. They've got their home. They've got a growing family. The home is no longer in either the location or gives them the accommodation size that they need for their growing family, and they need to upgrade. And in order to upgrade, whilst at the same time minimizing the amount of non-deductible debt, it might actually work out better selling some of those one or two investment assets. So in that situation, it might be worthwhile. And I put might because I don't want to sit here and say it's always going to be worthwhile. It really depends on circumstances, borrowing capacity, strategy, cash flow. There's lots of considerations, but I wouldn't discount it right from the get-go because, again, as I repeated before, is the whole point of investing in property at the beginning is to help yourself move forward, is to help you achieve lifestyle and financial goals. And sometimes selling helps you advance those goals. Because if you're taking equity out of a good asset and reinvesting that equity in even a better asset, that in the long run, that's how you're really going to achieve wealth. And I've seen lots of clients, for example, how do they get the $10 million family home? And I'm not saying that's going to be a goal for people, but, how do people get there without borrowing $10 million? Well, simply, they start, they buy something, they improve it, they upgrade, and they then upgrade to another better area and upgrade to another better area. And all of a sudden, 10 or 15 years later, they've got a $10 million family home with, substantially less debt. They wouldn't have been able to do that unless they bought and sold over that period of time. So I'm not suggesting we need to be really transactional, but also this belief that I should never ever sell isn't always true. I guess I'd say I never sell unless there's a substantial benefit to doing so.
Okay, and again, don't use your gut feel or emotion, but get somebody independent to give you some advice. Now, we spoke a couple of times about independent advice and your holistic approach. So just tell us quickly, what does Pro Solution Private Clients do for its clients?
We like to inspire our clients to adopt a holistic approach to building wealth. And I guess this episode to a large degree demonstrates why. Because when we're looking at these sorts of decisions, there's a lot of factors to take into account. A lot of them interlink with each other, taxation considerations, borrowing capacity, financial planning, all those sorts of things. So you really need then a mortgage broker and you need a tax accountant and you need a financial advisor. And if you can have them all on one team that are coordinated with each other, that are singing from the same hymn sheet, then my view is that you make the most of every opportunity and you minimize risks. And that's really the best way to harness wealth. So we believe in adopting a holistic approach, building long-term relationships with clients and helping them execute on their goals.
And I also like the fact that you're not just property specific or share specific or managed funds, and that's part of the holistic approach. Now, I didn't tell you, Stuart, this morning I was taking our dog Lincoln for a walk down the beach and I listened to your Investopoly podcast. I look forward to it every Wednesday. So people want to find out more about you. I'll leave a link in the show notes for Pro Solutions Private Clients, but also your Investopoly podcast and your great book, which interestingly has stood the test of time. It sets some great rules in Investopoly, and it's probably worth remembering that as we move through this cycle and the fantastic experience of a once-in-a-generation property boom that we had is going to be behind us, it's important to fall back to these fundamental rules, Stuart. Some of those fundamentals don't change.
No, that's right. And interestingly, well, maybe it's not that interesting, actually, probably predictable, that my wife and I were talking about buying an investment. I mean, we're talking about, we're always really talking about investing and buying property and so forth, but buying a property. And, I reflect that the sentiment's changed a lot. And you would have observed this too, Michael. The sentiment's changed a lot. And I'm kind of excited about it. There was one economist, Chris Joy, that came out last year that said, look, interest rates will rise, property prices will fall. And then really a lot of other economists have jumped on that bandwagon, including the big four banks. Let's not forget they predicted property prices to drop 30% when COVID hit, and that didn't happen. Obviously, it went the other way around. But it's an exciting time, I think, because when you have a market with negative sentiment, it is the best buying. That's when you're going to get the best buying opportunities.
And for people with a long-term perspective.
That's exactly right. But you've got to stick to those fundamentals, right? So the fundamentals suggest that, that is a really good buying opportunity. So for people that are interested in property and that are learning those fundamentals, I suspect, and hopefully almost crossing my fingers that there's a bit of negative sentiment out there over the next couple of years, it could create some great investment opportunities.
And you'll only know that when you look back a couple of years later. But again, that's part of the reason to have a plan and therefore not be sucked in by the media whose job it is to entertain you, to scare you, to get your eyeballs onto their websites where they keep talking about property markets crashing. Interestingly, I have a lot of respect for Christopher Joy, even though I think his estimates about what rising interest rates are going to do are wrong. And interestingly, he hasn't seemed to write about that for quite some time. But you're right, all the bank economists are now predicting rising interest rates starting as early as June. One's even suggesting March. But the Reserve Bank doesn't want to crash the property market. If interest rates rise, it'll be because inflation is doing well, because wages are doing well, our economy is doing well. So it's just going to want to slow it down a bit. It doesn't want to crash the markets. It wants that as much as a new strain of coronavirus, Stuart.
That's right, because we know falling property prices has a detriment to consumer confidence, and then falling consumer confidence means less spending, less consumer spending, which is not good for the economy. So we want to keep the property market healthy, of course. It's leveled off now in terms of growth, so the RBA wouldn't be worried about a housing bubble or those sorts of things. And at the end of the day, though, really, who cares what's going to happen over the next 12 to 24 months? That sort of commentary is meaningless. It's really about buying a really good quality asset that has all the sound fundamentals, holding it for the long term, hopefully never selling, Michael, despite our conversation today, and enjoying that compounding capital growth.
Look, based on what you said a moment ago about the negative effect of falling house prices, I think the Reserve Bank and the government recognises the positive effect of the wealth effect of increasing house prices. And what that really means is if people are feeling secure about their jobs, feeling secure about the value of their home, they go out and they spend on the economy, they do things. And that's really what the Reserve Bank wants to do. It recognises the importance of keeping the economy going through the wealth effect. Some people say it's a Ponzi scheme. I'd say the opposite. It's part of our government's job to look after the assets of that huge group of the population who've taken the time, risk and effort to buy their homes and or investment properties.
A little off topic, but if you indulge me, I will try and do this research and maybe write a blog about it at some point, but I would be most interested in learning the percentage of dwellings in a 15K radius of the main capital cities in Australia compared to other countries. Because my thesis is that density is more even in lots of other countries around the world, particularly when, people make comparisons of property prices versus what's happening in UK, US, Europe, western parts of Europe, etc. And they like to make those comparisons, and those comparisons highlight, look how expensive Australian property is, right? But my thesis would be that there's a large percentage in unit numbers of dwellings that are in that 15 kilometre radius of capital cities compared to other major countries or comparable countries. And really that's what's driving median property prices, or at least adding a lot to median property prices. Now, of course, in a rising tide, all ships rise. So in a very buoyant market, other property gets dragged along with it. But it is a very unique market, and people blame negative gearing and those sorts of things. But I think the makeup of our demographics, the fact that we've only got about 16, 17 million taxpayers in Australia, and the fact that we've got such a large geography that we can't service with infrastructure, and therefore we all need to live very close, or at least that's where the desire or demand is, really dictate what's going on in the Australian market.
We're living in world-class cities, and we're living in coastal cities, water-based cities, which all around the world, that's where people want to live and where the most expensive cities are. And there's a queue of people waiting to get into Australia, wanting to live here. You don't see a queue of people waiting to get into Indonesia or other countries. So it's the desirability, plus the fact that we are a knowledge-based country. We're not manufacturing things anymore. And so in general, we're more affluent, even though some of us are having financial challenges, so we can afford to pay more as well. And I believe if we believe our population is going to keep growing, and the government's got a business plan to do that, and you believe our wages are going to remain high compared to other countries, that's going to underpin property values in the long term.
Yeah, spot on.
So getting back to selling, I think we should only sell after carefully considering all the pros and cons. And as you said, there are many factors to consider, including taxation outcomes, cash flow, what your next investment strategy is, what else you could do. So it should also be done in context of your personalised long-term plan. And if you've got a plan, then you'll know if it's the right decision to make. So Stuart, thank you once again for your great insights. I'll leave a link to your Company Pro Solutions and your blog and podcast in the show notes. Catch up with you again real soon.
Thanks a lot, Michael. Enjoyed it.
In a moment, I'm going to share my regular mindset message with you. But before I do, I just want to follow on something that Stuart brought up a couple of moments ago about the fact that people are a bit nervous and uncertain about what's happening in the market at the moment. I'm currently seeing many people who are keen to get into property investing, either for the first time or for their next property, but they're scared of making the wrong decision. Now, I get it. There are so many mixed messages out there. It can be overwhelming. It can be confusing. Maybe it's the concerns about the overseas geopolitical problems. Maybe it's concerns about rising interest rates. And all the talk about our property markets faltering, even though Stuart and I told you that we actually see this as a good time. Or maybe it's some friend or family member like Uncle John at the Easter lunch that you had a while ago who told you that, he invested back in 1990 and had a bad experience. My suggestion is ignore these armchair experts. Everyone's got an opinion on you and your property investments, no matter how little expertise they possess. And while it's a great idea to get advice and support and help through your investment journey, make sure you're talking to the people who are experts. And that's one of the themes that came through my chat with Stuart. Now, don't pay attention to the experts in the media. As we started to say, the media loves fear, not facts. So please don't base any of your future investment decisions on baseless predictions made in the media. Don't make 30-year investment decisions on the last 30 days of news. So what should you do if you want to help your financial future, secure your financial future? If you're genuinely interested, you, I guess, realise, as we were saying with Stuart, that it doesn't just happen. You've got to plan for it. And property investment should be an important part of your wealth creation journey. And it's important to realise that it's a process. It's not an event. And the property you eventually buy will be the physical manifestation of a whole lot of important decisions that you've made along the way. So I recommend you have a chat with my team at Metropole, get them on your side to help you build a strategic property plan. So whether you're just starting as an investor or wanting to grow an existing portfolio, why not have a chat with one of our expert team at Metropole? Go to metropole.com.au. We offer you a time-tested system. We've got a proven track record. We've been involved in over $4.5 billion worth of property transactions. We've got property strategists who give sound, holistic advice, And then our own offices in Melbourne, Sydney and Brisbane with our own true on-the-ground team, not people who fly in and out as buyer's agents. We don't sell property, but we've got access to every property in the market. So go to metropole.com.au, find out a bit more about what we do. I'd love to be part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I want to talk with you about following your passion. Because you've probably read or you've probably heard that to be successful in all areas of your life, you must follow your passion. But what if it's more than that? Now, recently, one of my colleagues said to me, passion's for losers. To be successful, you need obsession. He then went on to say, passion leads to a hobby, obsession leads to winning. Now, I don't know if I totally agree with this sentiment. However, I tend to agree that even though his views certainly challenge the common thinking of follow your passion and you'll be successful, I sort of agree with what he's saying, because I think the point he was making was you can be passionate about something and still take little action. But when you've got an obsession, you wake up thinking about it, you spend the day focused on it, you go to bed planning for the next day. And you think about what you're going to do about it, and you do something about it. Deep down, we all know that Olympic gold medalists don't win because they're passionate. They win because their sport is an obsession. And my friend went on to say that most people's goals just aren't big enough to be an obsession. They're only big enough to be a passion. Now, again, I think that's an interesting view. Of course, he's suggesting that most people don't think big enough and don't believe in themselves strongly enough to achieve huge things. It was an interesting discussion. Now, in my mind, being an entrepreneur is a full contact sport. Running a business isn't a 9-to-5 job. It's not for the faint-hearted. Being a property investor involves all sorts of challenges and obstacles and hurdles along the way. It requires a level of belief and commitment that causes you, the entrepreneur, the businessman, to fly on a trapeze without a safety net sometimes. Being a serious property investor takes courage, resilience, and out-of-the-box thinking. Does that require more obsession than passion? I think so. If you enjoyed my chat with Stuart today, and I hope you did and got some new information, and you know somebody else who'd get benefit from hearing this discussion, please tell them about the Michael Yardney podcast. You'd be doing them a favour, and to be blunt, you'd be doing me a real favour, helping me make more people financially fluent. I have got the aim of helping more people, and that's actually working really well. Our subscriber numbers have increased substantially in the podcast, and I thank you for that. And as a way of saying thank you, I've got a gift for you. Go to podcastbonus.com.au. I'll leave a link in the show notes, podcastbonus.com.au, where I'll give you a gift of a bunch of ebooks and reports. Now, I'll be back again real soon, but you can catch me on social media. Just look for Michael Yardney. Of course, you can also join my private Facebook group by looking for the Property Update Facebook group on Facebook, of course. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?